We're often asked at Palmer Square, what are our best ideas in a marketplace that has seen, arguably equities richly valued and fixed income rates at, very, very drastic lows. And one of our answers, and I'll supply two, one of our answers is CLO debt. If you look today, CLO BB debt has a spread of around 700, 725. So 7.25% spread. Just to put that in a framework, high yield bond land BBs offer around 300, 310. Yet, CLOs have much better credit history. We believe, meaning there's been lower defaults in CLOs. We believe that liquidity is as good or better. And finally, you don't have any interest rate risk in that, minimal interest rate risk in that CLO BB debt is floating rate. So really for a combination of reasons, including a massive pickup in spread, plus the higher quality, plus the lack of interest rates, we like that area. And as we think about what might happen there, it's really interesting to note that if you look at the global IG index, IG being investment grade rated, and you take out the US, about 45% of debt today globally trades at negative yields. So what does that do? What that does is it pushes people to other areas of the world in search of income, in search of yield. And one area that we are bullish here on, as I mentioned, is CLOs. That is likely to be a recipient of that type of capital. We've seen it before, and what that does is it pushes spreads in and it pushes prices up. So we think CLO debt offers a wonderful total return opportunity today. The second is really more of something that we specialize and create here at Palmer Square. It's something called a static CLO. And a static CLO is essentially a CLO that is really typically lasting 2 years or less, so it's very short duration. It's instantly amortizing because there is not a reinvestment period. So the moment any bank loans prepay, they go to pay down debt. And we found that with those types of structures, the equity IRRs are not only significant, typically 12 to 15%. We've also found that the first year cash flows are typically 20 to 25%. And finally, we've also found that those types of structures don't offer much correlation to traditional stocks and bonds. So it's a great portfolio diversifier. So those are really two ideas that we continue to have high conviction in and believe that investors should consider as they're looking at different ways to allocate their portfolios.